Hello everyone, welcome to BISP Solutions. So today's ticket in TRCS is defining the tax automation rules. So first we'll understand what is tax automation and how you'll be working with this tax automation. So tax automation, it provides the data for core tax calculation. It represents the link between the book data and the tax data. Tax automation process will allow you to calculate permanent and temporary differences directly from the source financial data in the journal ledger or from the financial consolidation system. Using tax automation, the system starts the current provisioning process by copying the net income before tax amount into the net income of the current provision. You can create no entity global rule. You can also create entity specific rules. By default, global automation rules is enabled for all the entities. So after you load the trial balance data into the application, you can run the tax automation process to link the tax sensitive book data to one of these tax accounts like permanent difference accounts, temporary difference accounts, pre-tax income adjustments account, additional provisioning accounts. Using this feature, the system prepares current provision process by copying net income before tax amount from the entity's income statement into the net income before tax entry of the current provision. The tax automation process, it can also be used to automate the amount of net income before the tax adjustments that flow to the current provision. For example, book adjustments and book reclassifications. To enhance the flexibility of the tax automation, you can create multiple tax automation rules for each account, to which you can apply more than one rule or assign more than one source account or multi-gap source account. There are no restrictions on the number of rules that can be created. The additional rules enable you to define the logic to be applied. The logic can be pull logic, move logic, squeeze logic. You can create rules that use multiple pull or move or squeeze rules within a single rule or define the multiple rule combinations for more complex requirements that incorporate a flow within a rule, such as both pull and squeeze. For each rule, you can also select a different source account or the multi-gap source account, which will enable you to manage multiple source accounts more easily. You can run the tax automation for both national and regional accounts. And you can add tax automation rules to the data source dimension, as the data source dimension is used to create the members to store the tax automation rules. Now we'll see how to use this. This is a TRCS application. First, we need to do the configuration at the backend. For that, we'll go to application and configuration. Under that, you'll select tax automation. Here, you need to provide tax automation target account, scenario, year and period. So you need to provide this intersection. On the left, you can see all the tax related accounts, and you need to define that this is your tax related account, from which source account it should pull, so that to reflect the number in this particular tax related accounts. Now in the columns you have the logic which you need to apply, what percentage, which should be your source account on which you want to apply the percentage and the logic, and what is your source movement which should be pulled to your target movement, what is the source multi-gap and target multi-gap. Then you have the data source. You have the source scenario, source intercompany, source data source, source multi-gap. You have all these dimensions which needs to be defined. Now, if we parallelly open another application, means if I duplicate this application so that I will be able to make you understand, we'll open one configuration page on one application. Similarly, parallelly I'll open the current provision page, and third I'll open my income statement or balance sheet which I have loaded, so that I can compare how the flow is there. So if you're in the configuration card, the logic applied is net income before tax is my target account. Logic applied is pull. Percentage is 100% and the source account is profit before tax. Target movement is automated movement. These are all the automated rules. Before that, explaining this, I forgot to explain this. These are the global rules which will be applied on the whole application. You have the domicile rule which will be applied on particular jurisdiction. Then you have the entity rules which will be applied on each particular entity. Domicile will be applied on particular jurisdiction. Entity will be applied on a single particular entity. So we are working on the global rule. This will supersede global rule. Domicile rule supersede this, and entity rule will also supersede the global rules because they are more specific. That is by jurisdiction wise or by entity wise. So this is your NIBT, that is net income before tax, which you can see in your current provision page. We are saying that in this tax account, we want the data to be pulled from profit before tax account, and 100% data should be pulled, and it should reflect in target movement, that is automated. Now we'll see first our source account, that is profit before tax. What's the amount there in our source account? So we'll go to tax provisional national and we'll go to the forms. So under book data, under book data, you can select net. We are checking for net income, so select income statement by source. And here we are seeing for FY22 and P12 period entities operations USD. These are your intersections, and these are all my revenue, cost of goods sold, material and goods sold, gross margin. We'll search for profit before tax. So this is our profit before tax, that is 30399,094. Now we want, this is the trial balance what we loaded, that is nothing but the financial statements. Now this amount we want to bring to our tax account, that is NIBT, net income before tax. For that we'll go to tax provisional national and package. So when we define this rule, then we have to run our business rule from here for this particular period, that is FY22 P12. We'll run the business rule. All right, after this rule was run, now this amount which was there in our source account, that is profit before tax, that is 30399,094, it should reflect now in our target account, that is NIBT. We'll check. So our account is NIBT's net income before tax. You can see in automated movement, this is our movement. These are all my scenarios for we are checking for actual FY22 period is P12, entities operations USD, and these are my jurisdiction, multi-gap, currency and consolidation members. This is my movement that is automated, and we can see the same amount, that is 30399,094, which was nothing but coming from our source account. So this is how you do define the logics. We'll check one more. Suppose these are all the predefined ones. So meals is my target account, which is coming under national and regional pre-tax CATR. And here the logic is pull logic. Now we are saying that our source account is meals. Pull 50% from the source account and put it into the target account meals. And the movement is automated. Now we'll see meals in our income statement by source. So this is our meals amount, that is 422,898. So we have applied 50% on this logic. So we'll go to the current provision, we'll search. You can see this meals and entertainment. If you drill down this, 211,459 is the amount which is coming in our target movement. We'll check. We had 422,898 in our source. We are pulling 50%, that is 211,449 should come in the meals in our target. 211,449. You can see this is the amount which it should come, as it is pulling 50%. Similarly with the entertainment, because here it is meals and entertainment. In our source we have this meals and this is the entertainment, that is 194,114. 50% of this will be pulled. You can see in entertainment also the same logic is applied of 50%. We'll check one more for our movement. This is our movement logic. This is showing by date. So movement always says P12 of current year minus P12 of last year. And here it is not P12, sorry, it is any month of the current year for which you are calculating, minus P12 of the last year. So this is this formula is applied when we are doing the calculation for movement. Now movement logic says apply 100% on the source account, that is allowance for bad debt, and the target movement is automated, and the target account will be your bad debt. So first we'll see allowance for bad debt, that which is nothing, allowance for bad debt will be in our balance sheet. So we'll open our balance sheet form, that is balance sheet by source. We have this allowance for bad debt is 93640. So this is for this current year 93640. So this is 93640. We'll subtract now this was P22 FY22 P12. Now we'll check for FY previous year last month, that is FY21 P12. It will come under accounts receivable, and this is our allowance for bad debt, that is 46820. This is coming in our last year 46820. So the difference between both, that is 46820, should come in our current year with the help of the movement logic. So it should, in bed dates, we should see that the differential amount and 100% is applied. So it will pick in 2.1. Into 1. If it would have been applied 50%, so it would show this in 2.5. 23410, but right now it is showing 100%. So we should get this amount in our bed debts in current provision. So we'll have bed debts. Okay, this is the bed debt amount with bed debt row, and here you can see 46820 is nothing but what we have done the calculation. So this is coming with the help of the movement logic. In source, the amount was 46820. In target also we are fetching, not in source, this was a FY22. In source we have 934640 as a allowance for bed debt, but we are getting, with the help of the logic, we applied bed debt as 46820 with the help of the movement logic. So this is how we apply the logics in the configuration card, and after that when you run the business rule and we fetch the result in our current provision. So compare your financial statements that you loaded, that is your trial balance, with the current provision. So that's why it says tax automation will represent the link between the book data and the tax data. So this is how we do the configuration in our current provision. This is how we do the define the tax automation rules. There are many other logics as well. You have analyze, de-analyze logic also. De-analyze and analyze. Analyze logic is nothing but if you are in P1 period and the amount is 2500. Now if you want to calculate for P12, how will you do it? This is your analyze logic. Suppose your meals show 2500, and now you want the same to be calculated to estimate what your amount in P12. So you will do the analyze, that is 2500 into 12. If this is P1, if suppose this is P, in P4 you have 5000 of meals. Now you want to do calculation in P12. Now you want to do calculation in P12. So how are we doing it? First this 5000 is divided by 4 because it comprises in the 4th month. So first month will come 1250, that is P1 will come P1 shows 1250. Now P12 will be this into 12. So this amount will be coming in your P12 with the help of analyze logic. So any number of months, if you are right now you were in P4 and at that point of time you realized that you want this amount to be calculated in P12 period. Now vice versa is the case for de-analyze logic. You are in P, suppose 10. You have entertainment expense of 50,000. Now you want to calculate for at the point of P1, because you are now estimating your amount. This must be there for P10. If this is the expense, what should be there for the first month? So de-analyze is the back calculation. So 50,000 divided by 10 will be this. 5,000 will come for your, this 5,000 will be the with the help of de-analyze logic, you will get the amount at the period 1. So when you apply this logic, analyze or de-analyze, it will give you this calculation, and this was our movement logic. So it's up to you at what requirement is there. Accordingly, you will decide which logic to be applied. This was 1. This was analyze. This is de-analyze. We discussed the full logic. Similarly, you have prior year logic. Prior year logic or prior logic. So prior year, whatever is the amount in prior year, when you apply this, it automatically bring that amount in your current year. This logic. And if the prior logic is there, so if you will see, prior year. So whatever is amount there in prior year, it will bring copy the same amount in the current year as well. So this is how we do the tax automation rules, we define the tax automation rules and calculate our current provision. So yeah, that's all for today. We'll connect and discuss the next decade in our next session. Thank you. Have a nice day.